Good evening, guys. Ken at Tortoise Capital, small group coaching, cohort 2, January 14th, 2025. What is new and exciting, fellas?
I actually had a pretty good day today.
There was every opportunity.
Yeah, I guess something that I kind of struggle with sometimes as I learned this style of trading is if you look at the 10-minute chart from today on the SPY,
Yeah.
I mean, I think my 11-year-old son could have traded that beautifully.
Yeah.
Is there a feeling or intuition or a rule that you have when you say today I'm going to trade the 10-minute or the 3-minute or the 5?
Yeah,
Because today,
I just normally use the gap. So today there was a significant gap up. So I went to the 3 minutes so that I could go faster, and
okay,
then got chewed up on the first couple trades. If the 10-minute would have been a much cleaner right from the get go. There was a the more well. Let me just go ahead and show at least I'll show what I got in the 3 minute. Yeah, so I mean, I use 10-minute if it's an orderly opening, 3-minute or instantly if it's a big gap. And today was I treat it as a big gap. Let's see, share. Excuse me. Yeah, so this is what that 10-minute was like. You couldn't ask for a cleaner. Well, I mean, you could ask, but you wouldn't get it. But this was pretty clean. So yeah, this was the close. Here's the big gap up, and so I would have taken that one long and probably lost right here. Then I would have probably shorted here because I'm on the wrong side of the the downside of the VWAP, which is declining. I would have gotten out here. So that would have been this was probably a -1. That would have been minus 0.5. I probably would have taken that long just because now I'm crossing the VWAP. Would have lost another 0.5 there. Would have waited to this. And now here the rest of the day is just as nice as you could want. Although probably out here, re-enter here. So the 10-minute looks seductively easy.
yeah,
But by this point, if you get both of those shorts, you're probably net zero for the day because you lost a couple up in here. And then if you just stay with it, here's your turning point in the RL10. Here's a PSAR flip. Here's where the RL10 crosses the SMA 30. So somewhere in here, you're long, and then that feels you probably get out somewhere in this region. If you're still with it with a half an hour left in the session, and you get the crossing of the VWAP or the SMA 30, you get one more good one. And then if you're really aggressive, you're thinking about the return to the VWAP from here.
which it did.
Yeah. Yeah. So the afternoon trade, staying with it makes up for that. The shenanigans in that first half. But that's what the 10-minute looks like. That looks easier until you start working through it and you're living it. That one's harder than at first it seems.
What does the 5 minute or the 3 minute chart look
Yeah.
like?
So here's I was on the 3 minutes because of the sniper. Yeah. So here's what that 3 minute looks like. So let's see. There's my pen. So there's the close. There's the open. So I put my little OR3 bracket on it. Ended up getting short. Lose a half. This one holds the VWAP and gets a new high of the day. I get long. Crosses the VWAP, lose one. Hits the PSAR. Now the RL10 has crossed the VWAP, and I'm PSAR flip. So I feel pretty good about that short. Standard risk. That one pays off. Say again?
I'm sorry, it's my drink making a noise.
Yeah. So I get that one. That one is about, let's see, one. That's about +2. So we're net 0.5 right now. Here's your turning point right at the 3-day anchored VWAP. It crosses the dragon. I'm more than one risk box off the low. So I go ahead and try that there. The RL10 crossing the SMA 30 is right about there. So either one of those two entries is fine. I got the earlier one. I like it when they cross the dragon. That one, I'll take a 1, 2, 3 exit here. And that one gives me like +2. So now I'm at about 2.5. I looked at this one. This was already late in the day, and I don't really like trading it that late. But I did notice that one and say, yeah, that really feels like I want to do that. That one, by the time it gets to here, you shouldn't lose money on that trade. A logical exit would have been somewhere in this region, just short of the SMA 30. And then you might have tried a 1, 2, 3, but I didn't try either one of those. So I was happy to get out of that 2.5 today. And it was the afternoon trade again was the better one. And what I like after the morning, after that opening 90 minutes is over, I like clear turning points during the day. Even though that's kind of like lunchtime and stuff, I just feel like the orderly price moves favor me. And I try to keep my powder dry and my energy level high for that. And lunchtime also, if I'm at the college, is better for me because I'm normally done with classes by 10:30, which on this one is like 11:30. So this is where I'm normally I can be back in my office behind my closed door trading. So that's usually it. This is like prime time for me. So in actual practice, the 3 was probably a little better than the 10. The 10 looks easy today, but in practice, maybe not so much.
Yeah, I know some people like they won't trade until the first hour. You know,
After the first hour.
Yeah, they'll wait till 10:30. And I know
now that's the idea behind the frog, the slow frog, which was the original frog, always waited 60 minutes.
Yeah.
And the idea behind that was from the time of the open, and then it's open for 7.5 hours. That first 60 minutes, 90% of the time, you're going to see the high or the low of the day. 90%. So between here and about here, 90% of the time, that's going to be the high of the day. It was pretty close. And then the idea is that after that first hour is over, it's almost like an OR 60.
Yeah.
If you go OR 60, and then you just say, look, whichever way it's going when it leaves that first hour
Right.
is kind of the way I want to go. That
Sure.
would, so you always give them the first hour. Now, there's enough times when we also know that 2 times out of 5 that the open itself is within 10% of the low or the high of the day. So on days when you don't get that first hour of horsing around, but you get directional movement right away, if you wait a full hour, that thing might have just been going like that, and then you had to wait a full hour to get in. And then you come up here and you say, "Oh shit! Oh heck! This thing moved 1.5 or 2 frog boxes off the low, and only now can I get in." And it's already moved an average range or a half a range stat or something like that.
Right.
So that led us to say, well, why don't we, instead of waiting a full 60 minutes, why don't we just cut that in half and wait 30 minutes? And then that means on days where, especially where there's a big gap and it just reverses right away, you can then take a frog box off the low and get in, or you wait 30 minutes and you go in the direction it's going. It's like an OR 30. Then that caused us to say, well, what if we just, so we call that one the quick frog. It goes at 30 minutes. The slow frog goes at 60 minutes. The leapfrog just says, well, let me just put from the open, let me put a frog box on either side of the open, and then whichever way it goes, I'll go in that direction and then use the trailing frog box as a stop. And then we learned, hey, you could make that half a frog box from the open and go in the direction of the breakout and get to no lose plus dinner for 2, and then off you go. That's closer to what I do now, I would say, with the OR3 or OR10. But on a day like today where there's a kind of a big gap, I like to go, put half a frog box on it or an R5 or an R10 and go with the breakout immediately, not even waiting a certain number of minutes, just wait for price movement to tick me in. So there are times when waiting the full 60 minutes in retrospect looks perfect.
Yeah.
But we found out that one had something like a 54% win. And this is getting to be almost 10 years old since the last time that guy was trading it live. It was he had something like 800 trades in 3 months and was 54% win rate and had a 3-2 payoff. But the problem with his rule set that I thought was he was taking he was doing this with a frog box bracket from the open, and as soon as it moved to frog box he would go, and then he would trail with a frog box, and his average win was like 0.6, which meant that this thing had to go to plus 1.6 and then pull back a full 1 just to settle on 0.6. And that didn't look very efficient at all, because you ended up giving from the open, you didn't even get in until it was 1 frog box away. And then it ended up going 1.6 before it came back a full 1 to tick you out. And so you had a total move of 2.6 from the open to the upside, of which you were only capturing 0.6. And that's only like 25% efficiency. So what that did was drive us to say from the open, instead of waiting a full frog box, let me go with a minimum manageable risk box and get in sooner. And then after the turning point, from a maximum favorable excursion, it starts failing, don't let it come back a full frog box. Decide how to get out somewhere up in here better. And I personally think the current idea of the keep percentage, you just say, hey, from the maximum favorable excursion compared to my opening, let me keep 70% of that. That feels like a much simpler way to capture the biggest and best moves. So the original idea of the frog was to have the simplest number of rules possible, and then we have just been tweaking the heck out of it ever since, adding complexity, but making it harder to trade in some ways.
What time frame did you trade that in, or those stats?
Yeah. So when he was just using pure frog boxes, he was using a 1 minute chart and no indicators, because it's pure price action, right?
Right.
You just have from the moment of the opening, here's the open, it's right here. And as soon as it opens, he would just put the box either direction. And then as soon as it broke that threshold, he would go long. And if that was 2 minutes, he's in. If it was 30 minutes, he's in. And all it had to do was break that threshold.
Is it a discrete target set, or was he just picking critical states?
Yeah, we were looking at, he had 4 symbols on that. He was doing the S&P, IWM, Qs, and I want to say oil or treasuries.
Now, because you're going to get chopped a lot, right? With this,
yeah.
So it would be very frustrating.
Oh, it was hard.
Obviously,
it was 800 trades, and it was brutal.
Yeah, that would be very frustrating. Yeah.
Except
it made money.
You would take a coin flip that paid 3-2.
Yeah, no, I said it's going to make money, but it'd be very frustrating.
Oh, it's hard.
It seemed very for someone who wants to think.
Well, yeah, and the other side of that too is in retrospect, when you see what those rules hit, it looks like there's a lot of easier ways to be better on the entry and on the exit, which I think it's easier on the exit with that, like the keep percentage or at that time we weren't using indicators on the chart at all, but just pure stats. We were not taking advantage of what I consider to be a crucial improvement, which is the changing of the slope in the RL10. Like as soon as I see that and it's now sloping down, I'm ready to take a 2-bar low. So this would be just a natural exit. Whereas when the RL10 is still rolling up, this just feels like consolidation. But now you gave it 4 or 5 bars in here for it to keep going. You're supposed to keep going, buddy, but it didn't. Now, the fact that it did not follow through causes that slope to go negative. And then when you get that new 2-bar low right there, that just feels like that's it. That's resistance. And now, yeah.
Which bar is going to turn that RL10 down?
Just a second. So, this is the peak. So when this bar closes, then this prints here. So now price is right here on the skin of the dragon, which isn't bad. I mean, You could say, hey, the like a 2-bar low is probably here, or spine of the dragon. So you should be exiting in that live bar where the yellow dot is. That live bar should be exiting somewhere in this region, I would say. And I would call that failure to follow through. And that's a better exit than waiting for price to break the PSAR or to cross the VWAP or to cross the SMA 30, because there's the difference. That's a full R. The other side of that, you just say, look, if my entry is here and here's my maximum favorable excursion, there's half, here's a quarter and a quarter. That blue line, which it turns out is the 10-day anchored VWAP, that turns out to be a pretty good exit after the RL10 rolls over. And that one eliminates all of the timing problem with the PSAR. What you do is you use the slope of the RL10 being positive to help you sit on your hands while it's just chopping around. But then when that rolls over, you say, activate the rule of 4. Here's my entry. Here's my maximum favorable excursion. There's half. There's 75%, gives you that.
One of the things that I noticed, like with the PSAR, is that if you look at where the RL10 rolled over, okay, it's technically short, right? But what's price doing? It's coming right back towards it. You know what I mean?
Let's see. Yeah, well, this one, this one right here prints when this is closed. And that's still an upward slope right now. So really, this is the bar in question. That bar is the one that's either going to, now if it had closed higher, then the RL10 should do this if the trend is going to continue. And this is the bar that decides which way the slope is going to go. Because that closed lower, it closed all the way back here, that was enough to draw this down to here. And now the slope goes negative. So 10, 9, 8, 7, 6, 5, 2, 1. Yeah, so this is the minus 10 bar, and this is the close. So yeah, that slope, the regression line, the 10-period regression line actually would look like that. And that's where that perfect price is supposed to be. So now you had 5 bars where it did not make new highs. And that's enough to make that slope go from positive to negative. Now, price hasn't collapsed yet. You know, when this closes right here, this price hasn't collapsed, but the absence of follow through in 1, 2, 3, 4, 5 bars was enough to make this thing roll over.
I still think there's a relationship, because if you look at it, to my eyes, I mean, I like the dragon, but you've got your next target is the daily VWAP and then the 30 SMA.
Yeah. So this is one where you say, look, if this rolls over, you could almost say, look, from here, that's my high, right? And then you go back and you say, this was my last turning point. Draw that across. This is where that rule of 4 works. Now I say that's my sort of like maximum reasonable gain from the peak of the RL10 here to the bottom of the RL10 there is right here. And then half of that is, guess what? Right on the VWAP and the SMA 30. And half of that is here, and the next half is right, or next quarter is there. So what that would say is when this rolls over, you have to be short approximately there, because you've given up a quarter of the retracement. of the maximum retracement. And this idea has you trading between the turning points of the RL10. And so here's the one that you give it. You give it one, meaning you got to enter here. And then you aim for, that gives you 3 to aim for, of which you aim for 3. You'd settle for 2 if you got just back to the let's see, that's reds, that's the 5-day anchored VWAP, and you preserve 1. So what this one would do is you would get, using that logic, you could get short right here. As soon as that RL10 rolled over, now you have a short bias. You've measured the sort of the maximum reasonable move to the next previous turning point. You cut that in half twice. You mark it off in quarters. You give it 1, so you're short. You aim for 3. You'd settle for 2, and you're going to keep 1. So now you're short here, and this thing works out nice, and then comes almost to 2, and then starts working its way back. So you keep the 1. So you almost had 2, and you end up giving back this piece. That's what that simplified rule of 4 would give you. Give it 1, aim for 3, settle for 2, keep 1. And it does not rely on indicator interpretation. It is live price, pure price action.
I like it.
So, yeah. And the nice part of that entry, I think, if I recall, was something like here. And then you have a clear target ahead. As soon as that goes through there, you're starting to feel pretty good about this. And then this thing comes down and it goes through the 5-day anchored VWAP. And now you really feel good as it's starting to fail. And you say, man, it would not be surprising for that thing to come down to the 3-day anchored VWAP, which is also the turning point of the low of the day. So that would be a not surprising move, but it didn't. It rolled up to here. It is now starting to cruise back. So you don't let it get beyond the SMA 30 and the VWAP. Because if that was really going to fail, it's supposed to fail. But it's not. And we're late in the day. That thing now feels like it wants to come back to the VWAP. And so you got to get out by here. And then this was the real surprising move in the last 30 minutes, was a very strong close. So the futures traders would probably have been ready to carry that move onward after the close, would be my guess.
Yeah.
So the, in summary, this idea of the, so if I have a turning point in the RL10 and, comes this way, and then there's a turning point, as soon as that reverses, that slope of the RL10 reverses, I've probably got, let me get my pen here. I probably have some kind of VWAP floating around in the middle. And then that rule of 4, the simplified rule of 4 says, as soon as that turns, you measure from there to here, and you say, that's the new price channel until proven otherwise. Price would have to break through that previous, into emerging dragon territory before you have any evidence that that's no longer the channel. And the same token, if this thing were to roll over, you have a collapsing dragon all day and you want that one right away. So you define that new channel as between the two recent peaks of the RL10, and then that's where you say, all right, let me draw it at the 50-yard line, at 75 and 25, and you say, now when I bring that over this way, I have to be mathematically, to get a 3-to-1, I have to be entering right about here with a risk box that looks something like that. And then that gives me, because of math, it's going to be 1, 2, 3. Those are my 3 units of reasonable reward. It doesn't surprise me if I'm on like a 3-minute chart or even up to 10-minute chart sometimes, that the size of this box can be an R10, which is pretty cool. Because if this was really the low of the day, the range stat is 10 of these boxes to the upside. So if I give it 1, I'm really just, my first aiming for 3 is just the next 3 boxes of the range stat. And if that thing truly makes a range stat move, I could get another 3 and another 3. Because if that's the low of the day, that's the range stat move is 10 of those R10s. So with this one, what the turning point idea here is that I'm really just going to engineer the first 3 pieces of gain. Now, if I get all 3 and it breaks out higher on the emerging dragon, I can actually enter a second position because I still have 6 theoretical units of gain to the range stat on the upside. It's almost like the next higher time frame says there's 1 and there's 2 and there's 3. So the math on that really works out nice.
Are you going to assign an overall size of that? Because like if you look at your DIA 10-minute there, that's later in the day you had to come down, but that's a higher low, which means that's a short. Yeah, that's a short.
Yeah. Well, when this one, this is DIA. Yeah, this is DIA. When this one rolls over, so to follow the math again, here's the turning point. I have to go back to this one and say, here's the turning point. So I got to come to here. And now I'm looking at this, cutting in half and half.
Right.
And half. So I got to get short approximately there. Yeah. And now I'm thinking that a reasonable move would be to here. This one comes down not quite to 2 and starts to reverse. And so that would be the VWAP exit. So you'd only keep you'd end up getting short here and then exiting somewhere around in there.
Yeah. So you're looking for significant turns, not minor.
And that's why I think after that first hour is done, you start seeing the daily turning points on this one now look like this.
Yeah.
Oops, wrong one's right here. Yeah. So your daily turning points look like that, this, and that, which is nice because tomorrow you would see these two, that rising low. You'd be thinking that has some K2 action going on. So the fact that this closed here is nice, but the real price that I care about tomorrow is a breakout above today's high, because that's the first time this feels like a multi day emerging dragon. So tomorrow in DIA 425.50 is a really important price level.
Yeah, it's 58.30 on the S&P.
Yeah. And then if you were trading like a 30-minute swing, you might have an entry at 42.50 and your stop might be down underneath this 5-day VWAP. You might put a stop here, and that's a $2 stop, but on a $425 ETF, that's a 0.5%, which is fairly tight, right? So, this idea now, the rule of 4, is essentially, if I had a winning trade and I just wanted a mathematical price limit that let me keep 70%, that's how far from the maximum favorable excursion, how much did I give back? If I just say, hey, I only want to give back a maximum of 30% of my open gains, then mathematically I have to get out here no matter what the indicators say. That's just pure price. That same logic allows you to say, when this turning point happens, and then a move back to this price level is not irrational. There's about half. Here's another. I have to enter right about there in order to keep or to aim for 1, 2, 3 to because I'm looking back at this price level here. So that's actually like you give it a quarter retracement. This is like sort of a primitive Fibonacci retracement, but it's just using quarters instead of the fucking weird 68.235 or whatever it is.
You're not a believer.
I guess. Well, here's the way I look at that. Hey, what if if that was the move? Well, what's the retracement? The Fibonacci numbers are 50%, 31.7.
Yeah.
So if I'm getting in at 25, if it works, if it starts getting a bunch of buyers right there, then that tells me there's a bunch of Fibonacci players watching this. So I'm front running their little 31.7 or whatever that number is. I think it's 31.
Yeah. Yeah.
And then maybe if there's buying at the 50-yard line, then it's a slower fib guy. And then at 68.2, there might be a third pool of Fibonacci buyers. I hope they're all there. I hope there's a million Fibonacci.
And then you're close to your 2-hour battle drill. 2-hour.
Yeah. And if I just said the 2-hour battle drill, if I just divided that in thirds, I'm entering at 33. So I might as well enter at 31.2. But if I'm going to enter at 31.2, I might as well just enter at a quarter and just eyeball it and say, yeah, give him 1, aim for 3, settle for 2, keep 1. So that helps you with both the entry and the exit. Anyway, that's the main idea there. But yeah, to your point, to sum up what we said so far, the 10-minute looked very orderly and easy today. It was probably easier on the DIA than SPY, but it still was a little choppy in here and here. But once it got rolling, whether you were on the 3-minute or the 10-minute, you ended up getting this move and that move. And then depending on how aggressive you were with how much time is left in the day, you may or may not have gotten that move. If it was your only symbol, you might have said, why not?
Well, today was a little scary because we made a lot of money today. So I don't want to think I know what I'm doing just yet, but it worked today beautifully with the targets. But I almost think there's some value, and I may spend some money to do this. Like with the opening range trades, I had Phil do a little back testing.
Yeah,
but it's only, there are gap and go days. Okay,
yeah.
We've seen them, but the more I play around with this, like, we had one option today that I think we paid like $16 for, and I think it went to over 55. Okay. And we got out early. Okay. So you're like, damn, that was, 100 contracts. Okay. 100 contracts, you pay 16 and then it goes to 55. That's a big number. Okay. Because we're trading, pretty high delta options. But it's a $3 and $5 move that you can catch consistently is all you need. That's it.
Yep.
It's not, I don't need three $30 moves to make a good living doing this. And like, I almost think the OR trades should be,
the default.
Hey, if you make $1.50 or $2, that's a great start to the day. You know?
Why not get your feet wet?
That's it. Because
I just want to get it. I just want to jump in like a swimmers. They just want to jump in the pool and get wet.
Yeah.
And then get ready for the race.
Right.
My thoughts on the gap and go is that on my intraday, I always like to know where the 10-day range is, and a higher probability for a gap and go, in my view, occurs when, if at the open today, if it gaps below the previous 10-day low, then I think that one is going to pretty quickly either be that kind of day or this kind of day. And now going from below the 10-day low all the way to the previous 10-day high, that could be, an amazing one-day move. So what it needs was a special price location to make the gap even more significant. You'd like that to be simultaneously a big gap and then also violate a support or resistance, in the same way that if this thing had gone like this to a 10-day, and here's the 10-day high and it closed here, and then it gapped above here.
Right.
That's like after an earnings one, like the Nvidia's big one. That one is either going to just go like a nut, or it's going to revert back to, the 10-day anchored VWAP or the 10-day low or something like that. So big gaps after the 10-day range is violated seems to me to be more likely for bigger kinds of. This was almost that kind of, it gapped and then moved briefly above this is the 5-day anchored VWAP. So that looks like it. Hey, this could have been the one that really goes. That's why I was on it. And then, nope, not so much. And now this is staying inside between the 5-day and the 3-day anchored VWAPs. It's just trading inside the normal space. And there's your little. Now, if that's just like a normal oscillation, which is fine.
It is, but I think they're, again, it is a normal oscillation in a vol that's approaching 18, 19.
Yeah.
And that's why we're seeing big moves, because volatility's higher.
Yeah, because you got guys that are really leaning forward and saying, we're halfway through January. So in theory, all of the repositioning that had to be done with last year's annual money, where you sold your excess winners and you dollar cost averaged into your losers, in theory, that should all be done by now, by halfway through the month. So you've got all of the rebalancing from last year should be done by now. And any new money that comes in from pension funds at the start of January should be in. And now it's like game on for the second half of January. which way is this? And we're getting ready to inaugurate a president, which happens once every 4 years. And this guy's a goddamn lunatic.
I was about to say,
and he's replacing a robot. So you want to talk about maximum political turn? That clown still has 5 more days to implement dumb legislation or executive orders to screw with the economy.
I mean, he's
NVIDIA
just
got hit hard because he put some tariffs. Biden put tariffs on NVIDIA chips going to China. So they're getting smacked, and then that's going to have a chilling effect. So anyway, there's 5 more days of shenanigans but it's 3 more days of trading.
I'm having PTSD because I can remember when Trump was, and it's he is so antagonistic that the media does kind of want to attack him.
They sell a lot of newspapers and TV ads by being in, no matter what he says, to be in opposition to it.
He was running on, hey, I'm going to cut taxes and all that kind of stuff. And so there was an ABC News report that came out that basically insinuated he had, I don't remember what crime it was, but that one report tanked the market so hard that it literally cost me almost $1.8 million. Just like it was like I was literally in profit several $100,000, and then bam, $1.8 million goes away just like that.
Yeah. So
and
this is what
the report was false.
Yeah. This is what the Trump effect in 2016 looked like.
Well, he doesn't have that to sell anymore. So I mean, every Republican president basically since like 1950 has walked into a recession.
Yeah. So this one is, let's see if I can find this here.
I think we're going to take over Canada after we take over Greenland, Kevin. So
well, I think it's we just don't know which one we're going to take first, which is nice.
This cars thing. He just says, like, sorry, from our side, he just says the dumbest stuff. But we need our side to smarten up. So I'm okay with them joking around about this because our government needs to figure out. I mean, finally, our village idiot has retired or resigning. But this whole thing, the average car part crosses the border like 30 times.
It's so stupid.
He's like, let's tariff it. What are you talking about? Like 25% of your parts come from Canada because we're cheap.
Yeah.
That's the way you make more money, because we're cheap. And then they cross the border back and forth and back and forth.
It allows you to buy your car at a less cost. You sell more cars because they don't cost as much because you're using the law of comparative advantage.
Right. And it's like absolutely insane. And you're just like, you can't win this one. But I don't mind him saying it because our government has been absolutely ridiculous and they need to be smartened up. Right. So but it's funny. The things he says mean nothing. They're useless. But I don't necessarily don't think he's serious.
Yeah, the words.
There was actually a discussion the other day.
Yeah, they don't have
you guys
any
were going to
intention
invade Canada
like other guys. So this was the 2016 election right here, right? This was the first start of the box is October, and then that was oh shit, Trump is being elected. And then a flurry of activity starting here. And now suddenly, that's the previous all-time high. And then you have the Trump economy effect. And now the first 2 years, you got up into here. And now it's the silly season for elections against Biden. And then Biden takes over. No, this is COVID. Sorry. That's COVID right there. That isn't that that was the bond. I think maybe this was COVID 2018.
That's when Trump was going nuts against the Fed to try and get him to cut. Yeah. Because there was a big problem in 2018. Yeah.
Yeah. And then this is, I think, or is this? Yeah,
that's COVID there to the right.
That's COVID. And then
COVID's the right.
Yeah, I guess
Yeah,
that's
that one's
COVID.
COVID. Yeah.
2020. Okay. Yeah. So then that resolves and you say, oh shit. Well, this is what happens when you put $10 trillion of free money into the banks and corporations. And so now that looks like this was the original Trump shenanigans, and it doesn't look like much. But when you come forward, it looks very much like this is waiting for Trump in here. This little piece here, that's waiting for Trump. And we're still up at 582, down from 600. So that's only a 3% tail off. It feels bad, but that's only because prior to that, except for this one bad month here, it's gone from 400 to 600, a 50% move in a couple of years, or in a year and a half. So Monday's a new day, in America, in the world. It's like, now what the fuck are you gonna do? And God help us if they accept his sec def appointment. Hegseth, oh my God. This is buckle in.
So question on your new daily report.
Yeah.
There's the section in there that I think you added recently, talk about number of days in the market. Can you go over that for
number of days, holding X period?
Yes.
Yeah.
And get your bleach and Lysol ready, Kevin. That's what we're going to inject into you when we take over.
Yeah, blue lights and Clorox. All right, so this one is the this is that new one.
Yes.
And let's see, find my
You did a good one. You went through this on one of your recent coaching. Was that cohort 3?
It's still, it's in, I can't remember which session it was, but
that's the same. That's the same chart here. Yeah.
So this goes back, I think this goes back 10 years. And so 10 years is 2,620 days of trading. So day minus 2620 to 2581 is a 40-day window. Okay. So if I took the I think it's price to price, so it's close to close. So if I bought it at the close on day minus 2620 and then held it for 40 days and just sold it, I get some kind of percentage gain. Okay. My 40-day hold. And so that's one data point, whatever that percentage was. And then I march it forward one day. I drop a day and add a day, and then calculate that percentage, and I record what that 40-day holding period was. So if I go back 10 years and do that and march it all the way until the close of today, I go back 40 days to the closing price and buy it, and then sell it today at the close. And what that trade is down 2.5% compared to 40 days ago at the close. Check or hold. And then the same thing for 20 days and 10 days and 5 days and just one day from close to close. So over the last 20 days, we're down 3.7. Last 10 days, we're down 2.2. Down last 5 days, down 2.2. And we're up 0.1 day over day. Now, so if I count up all those, there's 2,580 days, or I'm sorry, 2,580 40-day holding periods in the last 10 years. So what I do then is then have the spreadsheet find the maximum, the minimum, the average, and then the standard deviation of that entire data set. And then that allows me to get, if I bracket the average 40-day holding period, then this gives me a data plot that looks like that. And because of math, about 1/3 of the data fits between average and +1 and between average and -1. So about 2/3 of the data fits between +1 and -1 z-score. Check?
Check.
That's assuming normal distribution, though, right?
Nope. It's absolutely no. It shows it's not a normal distribution actually, but what it does say, it has a distribution that looks like that. A normal distribution would look like this. Imagine that was perfect. You'd have a your average would be here,
right,
and you'd have very clean at -3 and +3, 99.5% of the data is between plus and -3, and the tails beyond 3 are functionally non-existent. They just don't ever happen. When you take a look at this, you find that the maximum positive gain was 4.9. So it went almost out to 5. And the worst one was -6. So when you plot this out and you look at the histogram, the range of distributions for these holding periods looks like this. It's almost like you pinched the standard normal, you pushed in with your fingers, and you get a larger than normal cluster of tightly compressed data in here, but you also get these really fat tails that just keep going. All right. And as you shorten up the holding period, those tails get fatter. So here's what I want to show you. That's very interesting. So the worst z-score on the 5-day was a -8, whereas on a -40 it was -6. The worst 40-day holding period lost 32%. The worst 20-day holding period lost 31.5%. The worst 10-day lost 23.3. The worst 5-day lost 18%. So in terms of efficiency, the 5-day holding period is massively good, because in a 40-day period that lost 32%, the worst 5-day holding period in here lost 18. That's like 60% of the loss that you experienced over 40 days occurred within a 5-day period. So that what that looks like is you might have had things marching up the stairs, and then 5 days just drop like a damn stone, and then some more follow through, and then leveling out. So the 5-day adverse move will just blow up all those longer term holds. So it turns out that the 5-day time range is really crucial. So when I was constructing the sniper setup, I was concerned about the 5-day volatility. So by which I mean for the last 5 days, what was the 5-day high? What was the 5-day low? So that gives me the trading range of the last 5 days. So high minus low divided by price now gives me a range percentage. So I can do the same thing now and say, what is the current 5-day volatility? There are two places where the 5-day volatility really get my attention. When it's abnormally volatile, in other words, more than one standard deviation above the long-term average, or abnormally quiet, more than one standard deviation below the long-term average. Here's why that's interesting. If the 5-day volatility is volatile, then you might have had something like 5 soldiers marching or whatever that candlestick is. You got a really strong directional move for 5 days. And then from close to close, that's a really amazing move. The average 5-day move is only 0.3. But if it went 0.3 plus 2.6, it takes a 3% gain over 5 days to put it in the volatile camp. You might have gotten that with 5 days of 0.6. Each day it was up 0.6, 5 days in a row. That would get you to officially a volatile move. That's a symbol that's in play on the swing. And now I'm very interested in trading that because I think there's a good chance that momentum could keep going. Oops, get back to that. Yeah. So now there's a very good chance after 5 days of steady directional movement that this could be the beginning of what could be a really long-term swing. Or I might have had something that was 5 days quiet. Now, if I had small ranges and the net of 5 days was less than 0.3 minus, yeah. So if I'm in here around 0.3 or below, I've got a really compressed 5-day range. It's quiet. Yeah, too quiet. So now if I bracket that, the first day breakout of that could have been, if that was a plus 3% day, I might have had quiet, 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 boom. Well, that's going to draw everybody's attention because it's so different from this. And now the second day momentum after that might lead to, the response to a blowout earnings. So the 5-day Z-score tells you if it's interesting or not. And then this column on SPY produces this chart up here by just looking at the key numbers. But what I do on this one is I have all of the other symbols that I'm kind of interested in by default. We get the Qs, the diamonds, mid caps, small caps, Euro Asia. Then I got the sector spiders, tech, energy, finance, industrials. And then my story stocks, Tesla, NVIDIA, Palantir, a couple guys that I like to trade. Anyway, Cliff, Devon, International Paper, and Alcoa. And then these marijuana and real estate or regional banks are routinely volatile. And then Intel, just because they suck so bad, in a world being dominated by semiconductors, these guys can't even stay in business. So they're horrible. And then AMD was actually down 60% last year. at a time when they're the only serious contender, non-Taiwanese contender against NVIDIA for GPU chips for AI. So both of those are story stocks because they're not NVIDIA. The fact that NVIDIA is so interesting makes Intel and AMD part of that, not a pair trade, it's like a trio trade, if you will. So as it stands right now, NVIDIA last year could do no wrong, and Intel just got slaughtered, and AMD was just about as bad from a share price. If people say, hey, NVIDIA, that's enough, let me go look at AMD because that's a $1 trillion company. You're a $3 trillion company. It may be I take some of my excess cash and roll it into AMD and watch for them to become competitive. Or if that's not stupid enough, I said, well, maybe Intel will find themselves and recover. Maybe great American name that they are, we're going to get some government money to bail them out. Probably not going to work because there was already a U.S. chip fund of about 50 billion set aside to fund U.S. chip makers to bring all the manufacturing back to the States. And Intel got a bunch of that money and promptly squandered it. So the whole point of this table then is to help me understand, in this case for the market, where is it in the Z-score? What this one looks like is the 20-day and the 5-day sell-offs, because the Z-score is worse than -1, have underperformed spectacularly to the point where this might be a bullish buy on dip opportunity. And if you look at today's this is today's numbers for today's report. Everything sucks except for today. So what's that look like? It looks like a bull and then a 3% sell-off. And today was the first day of not selling. Well, what's that look like? It looks like an SSC in a sense. Because I could now say, well, what if yesterday's low really was the low? This is around, in S&P, this is around 580-ish. Here's the magic number of about 600. And here's the magic number of all-time high up around 610-ish. So conceivably, there's about a $30 move in SPY for not much risk if this support level is going to hold.
Yeah, so I think the RL10 is the R. I mean the Z scores on the back of the report are kind of indicating we're due for a bounce.
Yeah, the failure to fail further. You would normally think of this as, well, if this was the let me get my come on pen. Get some purple action here. If this was the all-time high around 610, you would think, hey, a sell-off at 10% is the beginning of a correction. This thing only sold off 3%. And if this is bouncing, then that doesn't look like anything like panic selling. This is just a little bit of repositioning. Some of the excess gains of NVIDIA and Palantir being schmoozed over into some of the other underperformers. Like a 10% sell-off would have had this thing minus $61. This would have had to come back to 550. So this was at its worst, maybe like 5% from 610, right? So the fact that it didn't even get to a 5% sell-off or beyond, this feels like a 5% noise barrier, a noise region. So if this does hold, this could be a $30 move back to 610. And then if it does, a possible melt up. That's the Trump effect after all this stuff clears. So, sort of in conclusion, what this simple little table does is allows you to define what the normal moves look like for these different shorter term time frames, and then quickly compute the z-score so you know if the people who have been holding that long are suffering abnormally or are abnormally joyful. The other thing that it shows really is just how important 5 days are. 5 days can make all the freaking difference in a long-term play. And just the fact that 60% of the extreme 40-day moves, 60% of it happened in 5 days. And even if you just went, if you were looking at 40, the 20-day look back, why would you ever look at 40? He was up 23 compared to 31. He was down 31 and a half compared to 32. That's how violent the sell-offs actually occur. The other thing this shows is that sell-offs are more violent than gains. And we know that, but this puts some precision into that move.
Yeah. And I also think that the sell-offs it's going to be quicker because it's just because of the computing, AI, algorithms, and
especially the stronger the bull, if that bull has become abnormally strong, then now I am a motivated protector of my excess gains, which means I'm more likely to be buying insurance. Okay, the VIX is going to start responding as that happens. And at the first sign of weakness, I may be motivated to sell more, which is going to trigger some more downside momentum, which triggers more momentum, et cetera, et cetera. So you get that chain of fear about holding on to your abnormal gains. And after a year when the S&P was up 24.5%, there's a lot of guys that say, man, I can't afford to give all that back. And the first 2 weeks of January have been down 3.7%. Between that and it's really about 3%, right, from ultimately. So that's how I use this. And then this just gives me some other things to look at. So I could do this. Like right now, all of the US symbols for 40 days are like this. Everything sucks. Hey, what doesn't suck? Tesla is positive. Palantir is positive. Oh, that's cool. Tesla is still up 20% compared to where it was 40 days ago, whereas the market's down 2.5%. So the things that are in the white look different. On a 5-day score, if I come down to here, I'd say, well, energy is bucking the trend. It's got a z-score of +1, whereas all of the US and the globals are negative. So that's a case where market down, energy tactically up. And the fact that he's up over his z-score is greater than 1, it's already had an abnormally good run for 5 days, 10 days. It's really been a 10-day run, right? It's up 7% over the last 10 days, which is a z-score of 1.2. So this, at a glance, can give you some short-term relative strength performance through a statistical lens. That's what I'm trying to say on that.
Got it.
Yep. This one just blows me away. When I first did that, I have been just astonished at that for 25 years, just how much that. Yeah, 60% of
on the return on this on the swing return to a swing 10-day high, does this give you any cause to say why don't you just use the 5? Because once you're there, you're almost nowhere.
Part of that is the I use 10-day high just because it's like 2 weeks, and you can see where the 10-day high is if you're just looking at bar charts. You'll see the peak of the mountain wherever the 10-day high was. That peak of that mountain is where you're trying to return to. I just think it draws a mammal,
more attention.
A mammal that's in pain is going to look back there and say, man, why didn't I sell on the day that it had the 10-day high? Dummy. If I could just hold on, if it would just return to that 10-day high, then I'll happily sell now that I get all my money back. So if it gets back near the 10-day high and starts to stall, or worse, doesn't quite get there and starts to sell off, now you say, well, shit, here's my second chance to sell almost at the 10-day high. I better not miss my chance this time. And that's what gives you a cotta 2 to the downside. Because you say, hey, there was my 10-day high. It's just a dip. It's gonna recover. Oh shit, no, it didn't. No, it didn't. Oh man, it's your oh good. It's now starting to climb the wall of worry again. Maybe that really was the low. And this is a buy on dip opportunity. So guys, come in. The test occurs up here. If this is really going to be a resumption of the primary trend, which is up, this must go through that level and create new highs. The downside of this is that everybody that owned it, that bought it around here and then held it through this drawdown and are suffering, have made themselves a sacred promise. It says, man, if it would just get back up to here, I can sell and get all my money back because somebody bought it right here. Usually me, so if there's motivated sellers here, they might start front running this, and now this thing starts rolling over. And now I've got a high and a lower high. And now this looks like a cotta 2 to the downside. And now if it breaks below this number, now I've got a collapsing dragon. So that's where I want to put a second position on. Why does it collapse right here? Because everybody that bought long to go this way put all their safety stops down here. So if this sell-off comes through the previous support, it's going to collect all of those, and that causes the collapse of the collapsing dragon, which is why the cotta 2 allows you to front run that a little bit. But to do that, you had to see a clear high, a clear lower high, and now this downward pressure. Intraday, we see that as a return to the SMA 30 or the intraday VWAP. On the swing patterns, this looks more like a return to the 30-day SMA, the middle of the river, or the 30-day low, or something like that. But so if I take that mentality, now let me go look at the, where's my 30-day? Yeah. So here's my last 30 days. Here's my all-time high, 30, and so also the 30-day high, and that's where the PSAR flipped when the RL10 went through the PSAR. That's why it flipped to here, and now we're on a 18-day sell-off. There's my all-time high at 610. Yesterday, here was the gap down on a Monday. So this was the sell-off, made a new 30-day low on Friday. Everybody panics and said they put in their market sell orders, they gap it down, and yesterday was a big move up. Today, big gap up, sell off, scares away all the chicken shits, and now it closed above the intraday VWAP. This is some tactical shenanigans, but we're still in the bottom quarter of, if that was 100 and this is 0, here's the 50, here's the rule of 4, half, which is the 10-day high, and half again. That means somewhere around here, somewhere around 583, 584, you got to be a buyer if you want 3 to 1. What's that mean? That means anything above today's high is an auto buy. And then here's your first checkpoint, the PSAR flip. Second checkpoint is the SMA 30. Here's your 30-day anchored VWAP. You're already above the 5-day and the 3-day anchored VWAP. The 3-day started to reverse. The 5-day hit a low today. Tomorrow, if there's gains, that's going to turn. So you got to get through the 10-day anchored VWAP, across the dragon, flip the PSAR, 30-day VWAP, SMA 30, 5-day high, 10-day high, dragon peak, RL10 peak. So you got about 10 or 15 price levels on this ladder of fear and tears, right? Of your grind. So tomorrow, if it's above 585, I'm an automatic buyer. This would be my stop if I was just using the yellow zone. And then just to the 10-day high, that's a 2 to 1. So done. I'm on the, how much more do I need to be persuaded? Yeah, it's unpopular. Yeah, that's why it could work. But as Jay points out, the SMA or the RL10 just hit a low in here. If we get another day up and it closes well, that's going to make the RL10 reverse, which now officially flips us to the long side bias. Check. So if I did that as the rule of 4s, I could take the bottom of the RL10, set that equal to 0, go to the previous peak of the RL10, 610. Now I can divide that into 4s. So here's my strategy. Tomorrow, I'm a buyer at 585. If it gets above 590, that's a second position. If it gets above 595 or the SMA 30, that's a third position. And then I'm going to be stalking my exit in this region on the anticipation that it will fail to break out to new highs. That would be too much to ask for. Bless you. So once it's on the other side of the SMA 30, which is here, anytime I'm buying in here, I'm buying on the value side of the SMA 30. And I've got a 3 to 1 by buying here or here, I've clearly got a 3 to 1 back to the all-time high. I got 2 to 1 to the 10-day high. So I can afford to be a value buyer in here, but I got to see some strength tomorrow. And here's how I look at the rest of the week. So tomorrow is a Wednesday, and then there's a Thursday, and then there's a Friday, and then there's a weekend, and then somewhere in there's a President's Day. So guess what these next 3 days are? Pure tactical trading in front of the inauguration and a long weekend. So am I going to hold anything over this weekend? I am not. I'm going to be a pure day trader and very short-term swing trader. I might hold something overnight, but man, it would have to be an amazing win to keep something overnight on those 3 days. For my day
the fireworks start tomorrow at 8:30 when CPI is announced.
Yeah, and Katie barred the door. That the first hour tomorrow is going to be massive. I wouldn't be surprised, he said, not wanting to predict. So tomorrow is going to be a day when if we get a big gap, here's the close, and let's say it gaps way up, that's where I'm going to quickly put my little R10 box or an R5 box around the open, and then take the first breakout in either direction and be violently aggressive of locking in gains. That's my first hour tomorrow. And then I'll wait to see what the rest of the day on Wednesday looks like. Probably be flat. It would have to be a really good day tomorrow to carry something over into Thursday. Thursday, especially flat. And Friday, 100% absolute certainty. Under no conditions will I not be flat on Friday. And I'm going to take all of this as the, pre-inauguration day, the last inning of this game. And then the day after the inauguration, let the games begin. Mr. Trump, it's your turn. How do you respond? That kind of shit, right?
Yeah.
And then it's all tactics. Even then, it's going to be tactics till it gets above 610. And 550, way down here, is where the 10% correction language begins, right? The 5% correction is probably right around here, around 580. That's probably the 5% correction. So between 580 and 560 or 550, I should say, that $30 in here is where guys who are trying to front run the 10% correction. So we're in tactical trading space right here. And I just think the next 3 days are going to be an amazing set of intraday moves. And, NVIDIA, well, let's look at the story stocks today. All my little story stocks, UMAC 8.5, BBAI 6.7, PTIR 3. Where's my Palantir 1.5? So, the story stocks, there's guys buying those things today after 3 or 4 days of just ass whooping. The bigger story stocks, problems. NVIDIA and Tesla, not so good. So I'll be ready on tomorrow for follow through on Palantir, UMAC, and BBAI. I'll be looking if the market's up but those are down, then I have a short. I don't think the market stays up for very long. It's hard for the market to keep going up if those two big boys are not working. So anyway, that's sort of that's the short explanation of that chart. That's the long explanation of that chart.
Thank you.
Good. Thanks.
Okay. I got us at 90 minutes. I'll get this published and posted and get it hung in your cohort. All righty.
All right. Thanks.
We'll be ready for them tomorrow. You guys take good care. We're slowly coming back up into the Fahrenheit around the 15, 20 degrees. So not quite as bad as it was over the weekend. No, we haven't had any more snow except that 1 11-inch day.
You can have some of ours.
No, yeah, that's okay. We'll wait till you're a state, then you can ship it all south. And there won't be a tariff on.
Hey,
Canadian
you
snow.
could melt it so you could have some water for the reservoirs.
There you go. Well, we'd have to fix the reservoirs first. What they did was drained them and then didn't fix them. We're so stupid.
Morons. Yeah.
And then you watch the Democratic politicians out there on camera. They look like a stunned mullet. I mean, it looks literally like you hit a fish over the head with that mouth open and can't answer a question. Jesus, how do they get a mullet? Yeah. All right, fellas, take good care.
Right. Okay, good. See ya. Later.